Well, you should be able to guess where I am with this little girl looking up at the stock exchange. I'm on Wall Street up here, Washington stands. I was actually a managing director down the road here at Deutsche Bank on the first day of the Occupy Wall Street protests, and I came down, took my suit jacket off and came down and joined the protests and found myself chanting, "We want democracy now," right under that statue of Washington. It's one of my favorite Wall Street memories. And I was like, these guys, yeah, I don't think it's going to work out that well. Anyway, let's do the Wall Street background. Oil on Wall Street is what we talk about, and obviously the subject this week has been OPEC. Everyone's suddenly very bearish, and I think quite rightly. Just because, you know, OPEC has reminded everyone of an issue that we've been talking about for quite some time, which is the excess spare capacity in the market. Now, of course, the numbers of 2.2 million barrels a day of incremental supply from OPEC resuming higher levels of production includes a whole chunk of Saudi that will probably never come to pass, you know, given that they've actually moved to reduce their long-term capacity. But nevertheless, particularly the move by the UAE to get a higher quota, which they've been pressing for a couple of years now, basically tells you that, such as it was, the UAE put is going out of the market, which is to say the UAE always supported Saudi and basically was an incremental cut on top of any Saudi cut. That's going to change, and the market's rightly taken that quite badly, because the UAE basically has 100+ billion barrels of oil reserves, which at current rates is about 100 years reserves life, and they want to produce more, and they're talking about going to 5 million. And that supply comes on top, of course, of quite decent non-OPEC supply next year, and leaves everyone very worried and looking around for where the demand growth can possibly dig us out of this hole. And it just doesn't look like, given that we're at record levels of demand and we're going into what's likely a recession based on all other indicators apart from Nvidia, which is separate to the entire market. The whole AI thing is not part of the underlying economic story. The underlying economic story is weakening absolutely considerably, as is basically the market ex Nvidia and AI. And as a result, you're looking at weaker demand for oil into a situation where everyone's suddenly been reminded that there's too much spare capacity. So it's shaping up pretty bearish right here. Now, having said that, of course, we're going into summer. You're going to get extreme heat. You're going to get oil use for electricity, which is going to be an ongoing theme. You're going to get less exports from the Middle East because of domestic use of oil for power burn. You're going to get heat waves in India that have already started with a lot of distillate burn there. The list goes on. And, you know, we've had nothing but wet weekends here in the northeast US, New York, and now it's summer. I've started driving the car more. I'm getting a lot more parking tickets. You know, you can tell by my parking ticket indicator has gone crazy. So long and short of it is, don't get too depressed in the very short term, but I think everyone's going to be slightly looking at the exits here. Now, of course, it's positive refining, theoretically, depending on how you view the recessionary outlook, if there's too much crude. And the refiners continue to perform extremely well. And you know, structurally, we just like that group. Amongst the oils, it gets pretty tricky to love any of them. Obviously, Exxon comes through on the refining call, and the big guys, Chevron and Conoco, are going to do fine. But one of the problems that OPEC has here, which is incrementally bearish, is that trying to shut down US production now is a question of going after Exxon, Chevron, and Conoco, who have absolutely pristine balance sheets, as does the rest of the US E&P industry. So the potential for significant downside here over the next 2 years is quite considerable. Okay, on that incredibly depressing note, we'll see what happens next. There you go, New York Stock Exchange. In fact, one thing you might see is a couple of oil companies IPOing, which would be quite interesting over the coming weeks and months. And we're increasingly talking about international oils as being interesting because they're all so beaten up. Believe it or not, you know, there's some interest in international